Look, we've got a lot to get through today. I was reviewing the material in reference to today's presentation. I had a look back at the webinars that I did last year, as well as earlier in the year, and 12 months ago, a lot of the things that we're talking about today sort of were forecasted from a conversation piece as part of some ongoing changes. So it's really amazing how much change we've seen in the SMSF space over the previous sort of 12 months. And of course, this is all continuation on from the super reform from 2017. You know, whether 2022 is going to be the end of the reform, who knows? But it certainly kept me busy, and it certainly keeps you all as trustees on your toes with regards to what the current rules are. So, look, there's my standard disclaimer, and of course in today's session I will be talking a little bit about some proposed legislation as well. So mindful to note that it's important that law hasn't come in yet. So be mindful that you don't operate under any of those conditions until they are passed, which is likely to be 1 July 2022 from an operational point of view. But I'll go through all of that as the session progresses. So, look, the primary part of today's presentation for me is this issue of non-arm's length expenses and keeping things commercial. So in probably 2017 or prior to that actually, but around then the government got serious about identifying how super funds or how some parties were trying to, I guess, bring money into the superannuation environment with the reduction of contribution caps and other things. And so they looked at tightening up a lot of rules around the expenses that funds were incorporating to effectively enhance the income. And it's resulted in a lot of backwards and forwards between industry and the tax office, particularly about how the law is going to operate. And I think it's really critical that SMSF trustees have a pretty solid understanding of how they need to operate, particularly in the expense rate, in the expense sort of area, because when we go and pay for things, we want to make sure that they're all done on a commercial basis. So today I'm going to focus on the issues of undertaking responsibilities in your trustee capacity versus undertaking responsibilities in an individual capacity, and how the two can differ and create issues for the fund. I'll briefly touch on 6-member funds and just run through ultimately, I guess, a couple of key areas that I see with the introduction since 1 July of the ability to move up to 6 members. And then I will go through or finish off with a little bit about the director IDs, and you would have seen some communication from us earlier this week if you have a corporate trustee, but also there's some recent announcements and recent legislation introduced as a result of the federal budget this year, and so it's good to keep up to date with that to be ready to operate in the new environment come 2022 if we get to that position. So as always, if you've got any questions, please don't hesitate to just click on the Q&A box and enter those questions, and I'll answer them either as I go along, or I'll take the time at the end of the presentation to work through anything that people have asked. I'll also make sure, because normally this is one of the first questions, that everybody that attends today will get a copy of the slides. There are a couple of links, or at least a link reference within the slide. So we'll also send you links in the email that you've registered with. We'll send you links to the areas that I have referenced throughout the presentation. So let's jump straight into it, and let's start talking about these non-arm's length expenses and how they are impacting self-managed superannuation funds. So in effect, what happened was, many years ago, so in the early infancy of self-managed super funds, there was a lot of transactions around super funds investing in private companies, super funds investing in private trusts, and the legislation was introduced to ensure that the income that was generated from those assets was such that it was commercial when compared to other styles of income that the fund would be receiving. And it was a way of ensuring that that superannuation funds and in essence self-managed super funds weren't funneling income from one area through these trusts and companies into their super fund to be taxed at the concessional tax rate of 15%. So they introduced this concept of non-arm's length income, and it was ultimately about whether or not parties were dealing with each other on an arm's length basis. Now, through the progression of time, we've seen some changes, and particularly a lot of changes were driven by the introduction of limited recourse borrowing arrangements. And without sort of harping too much on about them from a structural point of view, a lot of these changes were directly related to the concept that people would use lower than commercial interest rates, including 0% interest rate, to undertake a limited recourse borrowing arrangement. And the ATO felt that from a taxation point of view, that wasn't commercial, because no banks were lending at 0%. I know we got close, but the banks weren't lending at that low, so therefore you shouldn't be able to do it in a related sense. And if you were, then the income associated with that asset would be non-arm's length income and taxed at the top rate. And so ultimately what we got to is a situation where they expanded on the legislation around this non-arm's length income to say that it will arise if the parties are not dealing with each other at arm's length, if the income is more than it's expected to be derived if you are dealing at arm's length, if you incur a loss or an outgoing or expenditure that's less than you would expect to pay if you were dealing on arm's length. And I'm going to reference this term a little bit throughout the presentation, but the concept of mates rates. So if you scratch my back, I'll scratch yours type concept and give you a little bit of a discount, but I don't give that to everybody, then that's where you're dealing in a problematic sense from an SMSF transactional point of view. And so this is the new part that's been introduced from 1 July 2018, but it's actually in effect taken 3 years for the tax office to really sort of come to a final point in their interpretation of how this law will work. And so we need to pick up on that relatively quickly as SMSF trustees to ensure that we are operating on a commercial basis. So not only are we talking about that the income is more than otherwise would be expected, but if the expenses are less, including nil, and it also applies if we're transacting via an entitlement in a fixed trust. So if we buy units in a unit trust, and then that unit trust, the transactions inside that unit trust are also non-arm's length, then that can have flow-on effects to the superannuation fund. And the big picture of all this is that we apply a 45% tax rate to all ordinary and statutory income associated with the transaction. Now that's a big kick, particularly if you've got investments and you're selling them down in retirement phase, and they would normally be exempt income. Well, if there's a non-arm's length expense associated with that asset, particularly at purchase, then selling it down in pension will effectively be negated by the non-arm's length income rules, and you'll be subject to the 45% tax. So that's a fairly big whack for not dealing commercially along the way. Now, let's put this into perspective. The majority of superannuation funds deal on a day-to-day basis in very commercial terms, and for the majority of people, there won't be any sort of impact. However, it will only take one or two or one transaction for a fund to slip up, and you may not necessarily know that you've undertaken that sort of transaction. Hence why I'm going to work through the concept a little bit of individual versus trustee capacity as we go. So what you require is you do have to have there's a requirement for dealings between two parties, and those two parties can be yourself in multiple capacities. So there is that related party nature. However, what the government alluded to is that you don't actually have to be related to deal with each other on non-arm's length terms. And that's why I use references to mates rates, in that, it doesn't necessarily need to be a related party or a family member for it to be non-arm's length. It can be any sort of dealings that you're working through where the parties agree that, I'll do this for you, but I don't do this for anybody else. Once you start having those sorts of conversations, then you're dealing in territories that's going to be linked to non-arm's length income, and it's going to be problematic for the superannuation fund. So the whole point of this was that the legislation was there because there was an element of ambiguity around how the rules operated before 2018, because it was all about the income. And so therefore, as long as you were receiving, in theory, the same dividend level that all other shareholders were receiving, if you were receiving the same trust distributions based on your unit holdings, if you're receiving a commercial rate of rent, then you wouldn't really look too closely at the non-arm's length income provisions. However, if you hadn't paid appropriate expenses to get that income, then ultimately what the tax office were saying was you're getting more than you should have, because you couldn't hold that investment in its full capacity because of the expense rate applied. So really it was all about creating equality between both the expense side of the transaction and the income side to make sure that parties were dealing in the right space. So what the ATO have done, and where we've landed, is this ruling, LCR 2021/2. Now, I definitely will put a link to this ruling in with the copy of the slides, because I think there's quite a number of examples in there, and I think it's worth referencing those. And I'm going to touch on a few today, but of course, in a PowerPoint presentation, you don't want to see too many words on a slide, so I'll just sort of go through them in more general sense. But then you can take the time to have a look through some of the issues at your leisure afterwards. But what the tax office have identified or stated within this ruling is, if there is a sufficient nexus between the non-arm's length expense and the relevant ordinary or statutory income. So where is the link? Is there a link between the transaction that you're undertaking, right, and the income that you're generating for the fund? And if there's a link, then it will be a non-arm's length expense, which will then result in non-arm's length income. And those expenses can be deductible under your general deduction provisions, which of course we take care of a lot of that from an administrative point of view. But when you're undertaking expenses in the super fund sense, you might have your standard accounting expenses, investment expenses. Then you've got things like actuarial audit expenses and other sort of less specific ones as well. All of those different expenses, regardless of where they're deductible, can potentially be caught out under these arrangements. And I guess the issue associated with is that, if there's a transaction that occurs in a single year, and you potentially pay a lower expense on an ongoing nature for a transaction, then you might tarnish the income of the fund for that 1 year and go back the next year to being taxed at the normal tax rate. But in certain transactions and limited recourse borrowing arrangements, and many property transactions are ultimately the ones to be mindful of, is if the acquisition costs, so including the financing costs, has some form of discounting applied to it, so a lower than normal interest rate that's otherwise not available commercially, then not only are you tarnishing the rental income, but you're also tarnishing the capital income. And so even if you go and refinance the limited recourse borrowing arrangement at a later point in time to make it commercial, then you've tarnished all future income and all future capital gains associated with that transaction. So that's a fairly significant issue. So, clearly for anyone that didn't go back in 2015 and 16 and tidy up their limited recourse borrowing arrangements, then they could have some non-arm's length issues moving forward. But if we're going to do related party limited recourse borrowing arrangements, it's critical that we either follow the ATO's guidelines on what is commercial and what's not in their eyes, or we do the appropriate research ourselves to obtain what a lender would have given us. So if we can go to a bank and they say, yes, we would lend you at this rate and on these terms, and we then apply those rates and terms to a related loan, then at least you can identify that there's been commerciality considered in the transaction that's been undertaken. So you just need to be mindful of how these measures will work. Now, in most instances, the transactions are only going to impact the income associated with the asset that is linked to the non-arm's length expense. However, what the ruling did identify that there will be some expenses that have a nexus or this sufficient link to all of the income of the fund. And this is why a piece of legislation that came out in 2018 has effectively taken till 2021 to be finalised, because this concept of linking general fund expenses to all income is outside the scope of what this area has ever been for the majority of people, and the industry has really pushed back on the tax office, but the tax office have held relatively firm. But what it actually means is, if we're looking at our actuarial costs, our accounting fees, which includes administration, audit, cost of compliance, benefit payment costs, advisor fees, but then this last one, other administrative costs in managing the fund, those admin expenses that we pay out, if they're at a discounted rate, or if they're at a non-arm's length rate, then all of the income of the fund is going to be taxed as non-arm's length income, which would include contributions, dividends, rents, all sorts of other things that might be received. Now, the beauty of using, say, an administration platform like ours is that we charge, a commercial administration fee. We charge, our auditors charge a commercial rate. So all of those general expenses largely for you won't actually have this link to non-arm's length income, and so it's going to be the more specific nature of certain transactions that will effectively be the key points for you as trustees to be mindful of. And what I want to do is sort of work through, I guess, the key areas that I see in the admin space and the questions that I get asked on pretty much a daily basis from trustees and from our client managers here and others within the industry, with reference to whether a transaction is or isn't non-arm's length expense. It's generally around transactions linked to fund administration, accountants preparing and lodging returns, and as I said, not such an issue for those that use a service provider. But if you work for a service provider and that service provider provides you staff discount, then there are ramifications if those discounts aren't applied across all employees, and there's different rates for different people and other things. So again, it looks to the extent of how discounting can be applied, but it will also apply to our brokers, whether you're stockbrokers, insurance brokers, financial advisors, and any costs associated with the investment platforms and other things alike. And then the areas for me that I think are probably at greatest risk of being captured under the non-arm's length expenditure is more of our property style transactions, where we're dealing particularly in a building and construction or renovation or maintenance space for our self-managed fund. And historically, we have, in many instances, undertaken a lot of those duties to perform the maintenance, to do some repairs, to make some improvements. We've performed those duties ourselves, and at no or little cost to the superannuation fund. And historically, that sort of transaction has kind of been viewed as, okay, well, is it significant in value or not, as to whether or not it would trigger, say, things such as contributions or acquiring assets from related parties. And whilst those rules still apply, now we also have to think of it from a taxation point of view. So I want to touch on those areas as we go through. And I guess the question mark is, what are the other areas that are going to come out of the woodwork through these changes as they apply? So what I want to start with is this idea of undertaking transactions in either your capacity as a trustee or under your individual capacity. So you're in a capacity other than acting as trustee of the fund, because this is where people are going to be caught out with regards to how they transact. So as trustees, we're required to do things, and we're required to do things in accordance with the super law, with the trust deed, and also with trustee law. So for example, we're required to create an investment strategy for the fund, so that the whole concept of performing those tasks, we're required to lodge annual returns and keep records and all those sorts of things. So those sorts of things that we undertake, we're undertaking them in our trustee capacity. So if we've got the skills through our knowledge to be able to do our own administration, to lodge our own returns, and to do all the other roles that were required under the deed or under the law, then we can do those without sort of any inference to non-arm's length expenditure or income, and there won't be any tax ramifications. So, just undertaking the day-to-day activities of the fund, if you're performing those duties in your own capacity, then there's no issue. However, when we start to look at things and whether we're doing them in our individual capacity, then that's where we start to potentially cross boundaries with reference to the non-arm's length expenditure. And so we know, and I'll touch on in a minute, the issue around trustees and provision of remuneration. And we know that we cannot be remunerated in our capacity as trustee. But if we perform duties where we're licensed to be able to do it, we might be a licensed builder or something to that effect, and we then undertake tasks on behalf of our super fund, then we can actually be remunerated for that work. So if we are undertaking some form of work and we charge for that service, right, then we're doing it in an individual capacity. If we're using the equipment or the assets of our business in a material manner, then we're undertaking work in a individual capacity. And that's a real tricky one, is what is materiality when it comes to using our working tools and things. And I'll use a couple of examples from the ruling in a moment, but the whole idea of whether we perform maintenance on our investment properties and we use our own cleaning equipment to clean the place, well, you would think that that's immaterial from a concept point of view, versus if we are going and undertaking full maintenance and doing major repairs to the house and using equipment that we would also use in some other capacity, say as a small business operator where we do air conditioning installation. I know that's an example, so that's why I wanted to throw that out there. So how we use business assets can reflect on whether we're doing something in an individual or in a trustee capacity. If you're performing the services pursuant to a license or qualification, then and you can only perform it in accordance with that license, then you're dealing in an individual capacity. And there's a really good example of an electrician that I'll highlight through the presentation as well. So all these sorts of things sort of stack up to saying, okay, well, if we are undertaking certain roles on behalf of our superannuation fund, are we then creating a problem because we're not charging for those roles? Now, one of the questions that we get a lot for those of our funds that do hold property is, if we're engaging somebody to perform some work, so to do some renovations or to do some improvements, if on the weekends we're going in there ourselves and doing painting work or doing some of the tidying up work around the place, and so we're effectively providing our service for free, where does that sort of sit in this sort of transaction? And I guess the answer to that will lie somewhere in the detail of how much additional work you're doing. I mean, if you're doing sort of 30 or 40 hours of work of property maintenance on a place that you're renovating, then that would be fairly significant from a valuation point of view. However, if you're just doing a couple of hours on a weekend just to make the job easier for the tradespeople that you're getting in, and you're paying them commercially, well, then that's going to be looked at quite differently. So it's really about, I guess, the level of the work that you're actually performing as to how these matters are actually going to be captured. So, the whole trustee versus individual capacity is going to be, I guess, brought to the forefront of people's minds with regards to how we transact moving forward. So it comes back, and I mentioned before, this whole idea about discounting and reduced fees. And the ATO in their final ruling have basically stated that discounting in itself is not an uncommon practice. But ultimately, if there is discounting applied, then there needs to be some form of sound basis for how the amounts have been arrived at. So again, I come back to the concept of mates rates. Well, if those discounts are only being applied to one party and not to other parties, then that wouldn't necessarily be a sound basis and could trigger a non-arm's length expenditure approach. But what the tax office have said from a compliance point of view is that it's important that trustees at least go to a level of extent to identify commerciality in a transaction and then apply those principles to what they're spending. So, if we're quite flippant in the way that we go about things and say, well, no one's really going to look at this transaction, then I think there's a requirement to look over our shoulder a little bit and maybe watch out for what the auditor or the tax office will be looking for. Whereas if we've gone to the extent of going out and getting quotes, and I recently put my house on the market, and so I needed to get a number of jobs done that I knew that I couldn't do, and again, not being in my self-managed super fund, but I would go out and get a number of quotes to determine what was an appropriate amount to pay for what I needed to be done. And ultimately, what we're saying, or what the tax office is saying, is in your capacity as trustee, you've got to take that sort of approach with any sort of expenditure associated with the assets of the funds. So therefore, discounting that are consistent with normal commercial practices, right, are going to be okay. And you see these sorts of things where, and again, I keep coming back to property transactions, but there are lots of incentives and other things being offered for people to get into and rent or engage in leases for property. And those incentives are offered to all parties, regardless of the related nature. And so therefore, if it's okay for a non-related party to be entitled to those discountings or those incentives, then it's okay for the SMSF trustees, if they're leasing to a related party, to apply those similar sorts of incentives. So all of those sorts of things really comes back to consistency and commerciality. And then the last thing that the tax office are tending to look at is how much influence do you have on those pricing policies. So if you've got staffing discounts that you can offer, but you set them knowing that you're going to benefit from them the most, then does that sort of contradict the arm's length nature of the transaction? And what I would say in that scenario is that it's a little bit of probably, or there's going to be a requirement, I think, in many instances to at least speak to the tax office or at least get advice as to whether or not, from a taxation point of view, certain transactions are going to be satisfactory. But for the large part, I don't think that these measures should be introduced on any sort of scare basis or scare tactic basis, because for most people, we do deal on an arm's length basis. But I think we just need to be conscious that if we start to look for the deal that's better than what everyone else is getting, we just need to be conscious that it could actually have tax ramifications on the fund, and that's something for us to think through the process. But as I sort of alluded to, there's a bit of history behind all this as well, and I mentioned before about trustee remuneration, and I think for me that this is one of those key areas where we have to look at what's come before us. And how that's now going to be applied in accordance with the ATO's ruling that's recently been released. And so for me, there are three critical areas. So Section 17B of the SIS Act, and then an SMSF ruling, which was about what assets we can acquire from a related party, which was released back in 2010, and then a tax ruling from 2010 about what is a contribution. And I'm going to talk about those second rulings in a moment when I talk about acquiring assets from related parties, but I also want to touch on the remuneration of trustees, because it can occur. And so ultimately we get the situation, as I stated previously, that if you're doing something in an individual capacity and it's related to services that you're providing other than in your capacity as trustee, you can be remunerated, but you've got to be appropriately qualified and licensed to perform those various duties, and providing them in the ordinary course of business. Plus, they can be no more favourable to you as trustee compared to if you're dealing on an arm's length basis. So again, Section 17B, I think, ties in quite nicely with these non-arm's length expenditure rules, in that if you are performing services on behalf of your superannuation fund, and you have the capacity to charge, then the law gives you the capacity under super law to charge. And the tax law effectively backs it up and says, as long as it's commercial, well, you'll tick that box under 17B, but then you'll also tick the tax box and be taxed at the concessional tax rate. So I think 17B ties in quite nicely with how these changes were introduced. The tax ruling about the contributions, we've seen a change to that because of this non-arm's length expenditure, and the SMSF ruling 2010-1 has a number of examples which I think flow nicely into the way that this ruling has been written. Now, I'm speaking a little bit glowingly of the process. I'm not a big fan of these non-arm's length expense measures coming in, but I think what the ATO have tried to do in this instance is they've tried to get consistency across their historical documentation and their historical releases and what they've provided in this new environment. And so in many respects, there's probably a couple of areas that are a little bit questionable, but if we follow through the paths of each of these documents, that we will get to the same result. But what I want to highlight, and again, this is just more so referencing a couple of examples from those historical rulings, and working out what they mean in the new sense. So I just had a question come through, so I'll take that one now. If someone is a handyman doing renovations, are they considered qualified and licensed to perform renovations, and hence should they invoice the SMSF for their work? So that's a really good question there, Anthea, and I think that the concept comes down to, well, they'll know whether they're qualified or not because they'll either have a building license or they won't. So a general handyman individual, so somebody who thinks they have the capacity to undertake the various work to do renovations, they're not actually licensed to do it. They can't actually go out there and do it for somebody else and be paid for those services, because they're unlikely to go and declare that from an income tax point of view and provide that information as part of their annual tax return. So, you know, I think that there are obviously qualified builders, and then there are handy men and women who will go out there and undertake jobs because they've acquired those skills. And this comes back a little bit to that point previously. They've acquired those skills in their not skills that they're required to undertake as trustees of the fund. So then they would be performing those jobs in their capacity as an individual rather than in their capacity as a trustee. And this is what creates the problem, is that because they're not licensed and it's not work that they do on a commercial basis and provide those services to the public, if they pay themselves for that, then they're in breach of the superannuation legislation. Whereas if they don't pay themselves for it, then, which means they comply from a superannuation point of view, but it means that the expenditure of the fund, you know, doesn't correlate to the income that it's receiving, because the fund's had all these renovations done, all this work done, which enhances the value and potentially enhances the rent that it can receive, and therefore the taxation of the fund will be taxed at this higher rate. So ultimately what they need to do in that set of circumstances is they need to go out and get a qualified party to perform those duties. And or if it is minor insignificant work, and this is where these examples that I'm about to go through sort of highlight it, if it's minor insignificant work, then it's not going to be such a problem. The question is, what's minor, what's insignificant, and that's probably the boundaries that we still have to test. And so if we look at the two examples from the SMSF ruling, you've got the first one there who fixes some taps in a rental property owned by the self-managed superannuation fund. And you've got, you know, the costs of washers, and you know, it takes a few minutes of your time to take the tap off, to replace those washers and put it all back together. That's insignificant in value. So a trustee undertaking those sort of services is not going to be in any sort of non-arm's length expenditure issue, versus somebody who installs air conditioners, and therefore they provide that air conditioner and then they install the air conditioner for the investment property. Well, if they are a qualified air conditioner installer, then they've got to make sure that they charge the labour rate that they would charge on a commercial basis. So not only does the fund have to pay for the air conditioner, but it also then has to pay for the labour. So these are the sorts of areas that we have to, you know, find the balance between the cost of washers and the cost of an air conditioner. Now, again, that's a little bit of a throwaway from myself, but this is a problem sometimes with the way the ATO release information, is they give you sort of two levels of extreme, and we have to find the balance in between. But those sort of examples, you sort of say, okay, where does that flow on from 11 years ago? Where does that flow on to now in light of the new ruling that's been released? The tax office have provided, I guess, two fairly significant examples that talk about the provision of service and how that might apply from a sufficient or significant versus insignificant transactional point of view. And so, again, I did say that there'd be a lot of text on some of these slides, so I'm just going to summarise this one for you, but in example 9 from the ruling, it talks about Trang, who is a plumber and owns 2 investment properties inside her self-managed superannuation fund, and has an apprentice that works for her. Now, in this example, after work one night, Trang goes and installs a hot water system that's been supplied by the tenant, and uses the tools of her trade to do that. But it's effectively insignificant in value. So just goes, undertakes the work, does use the tools, does it after hours, so it doesn't impact any of the billable hours of the business that she operates. However, with the second property, where she's doing some renovations to the bathroom, and she takes the apprentice along, and they use the tools of the business to do the renovations. In that instance, what we would need to see is that that the business actually invoices the fund at the same commercial rates that it would any other client, and then they'd be able to perform those duties. And so again, it's a matter of size and substance of the transaction that will determine the nature of a lot of these things. So that's one example. And then the other example, which is the example of the electrician. Now, again, if you get a lot of electrical work done at your place, you'll know that you'll need to get a certificate of compliance provided. And so, if anybody is providing that certificate of compliance for the electrical work that's being done, then they're not doing it in their trustee capacity. They're doing it under their electrician's license requirements. And therefore, even the smallest of tasks in this example would result in a transaction potentially breaching the non-arm's length income issues if the fund doesn't pay the electrician for the work. So, it's often going to be a matter of what are our skill sets, what are our licensing obligations, what do we do on a day-to-day basis, and what size is the transaction in determining what we can actually do in the SMSF space. So I just think it's one of the key areas that we need to be mindful of, and an area that we'll continue to update our clients on, because I've taken a huge interest in this space right since it first came out, and have been in communication with the tax office about various transactions, and we'll keep doing that. And look, just to finish off the conversation around the non-arm's length nature of transaction, it also extends to acquiring assets. Now, if we're acquiring assets from a related party, I think in 99% of cases, there's no real issue here, because most self-managed super funds that deal with acquiring an asset from a related party understand that they have to do it at market value. But really, I think what's key in these transactions is how these transactions are documented. So if somebody looks to purchase an asset from a related party, and it might be shares or it might be business premises, if we're looking at acquiring it, and we're looking at doing a combination of a purchase and a contribution, then we need to make sure that we're documenting things, but identifying first and foremost that the transaction is being undertaken at market rates, and the acquisition cost is the market value, and then the entirety of the settlement transaction equals that market value. So what the tax office have identified is where somebody sees a property that's worth $800,000 and they pay $500,000 for it, and then once it's in the fund, they say, okay, well, that wasn't done at market value, so we'll substitute the market price and we'll treat the difference as a contribution. The tax office is in respect saying you can't do that. You can't fix it after the event, and you would tarnish the entirety of that transaction. What I see most self-managed super funds doing, and have seen them do for the past 20 odd years, is do the market value transaction. So it's really more about making sure your land titles documents, making sure your off-market transfers for shares are reflecting the actual market value, and then your supporting documentation states how much is a purchase and how much is a contribution. And the ATO have updated their tax ruling on that matter. So it is a key area for us to be mindful of. And so for me, it is about making sure we execute our documents correctly, that we understand as trustees what the consequences of undertaking certain transactions are and undertaking those transactions ourselves, that we do seek the appropriate quotes for services before undertaking action. So again, no mates rates to apply, and ensure that things are on a commercial basis. So, as I said, I wanted to cover off on that area. We'll provide more information for you all via the links when I send the presentation out to you. Now, before I talk about the recent legislative updates that have come through, I just wanted to touch very quickly on 6-member self-managed super funds, because this is obviously a new provision, and maybe not so obvious to everybody if you've got an established fund, but these are provisions that came in from the 1st of July this year, and it provides that we can now have up to 6 members in a self-managed superannuation fund. Now, in most instances, there's very little sort of compliance issues that we need to be mindful of with this change, but probably the most significant one from a legislative compliance point of view is that we have always had signing requirements. So if you have 2 trustees or one corporate director of a corporate trustee, then all trustees must sign the financial statements of the superannuation fund. And then what you had was, if you had 3 trustees or 4 trustees, it used to say at least 2 trustees had to sign. Now, of course, that we're moving up to 6, what we have is this requirement that if you have 1 or 2, then for individual trustees, all 2 trustees must sign. If you've got 2 directors or 1 director of a corporate trustee, then they all must sign. Once you have 3 or more members, then at least half of the trustees have to sign. So again, that doesn't change the old rule for the 3 and 4 member funds, because at least half means at least 2 people. But what it means is, if you've got a 6-member fund, then at least 3 people are responsible for the signing requirements. But of course, when you're contemplating 6-member funds, then you've got to think through a number of the positive and otherwise measures, negative measures of undertaking such a transaction. And my role, I think, is clearly about identifying some of the key issues if people are contemplating 6-member funds, because there are certainly some positive aspects to it. But then there are also some, I guess, negative connotations that can be linked by having more people associated with the fund. So clearly it does cater for larger families. Now, whether that actually translates to children wanting to join funds with parents, etc., that's time will tell. I know that we've certainly seen it in the first few months of this financial year, where we've had some funds adding more members to increase beyond what was previously 1 or 2 member funds. It does, in many respects, sort of highlight, and I'm going to talk about corporate trustees in a moment and director IDs, but what it does really do is it highlights that having a corporate trustee for a self-managed super fund is certainly, from a regulatory point of view, it is certainly the more appropriate trustee structure in accordance with the tax office. So I've had a question. And I might, Kathy, if it's okay, just leave that one to after this session and this section, and then I'll answer it in the general questions towards the end around binding death benefit nominations. So I'll certainly come back and answer that question for you in a moment. But if we're talking about establishment and administration side of things, there's a concept of that reduces costs. So I think that's a thing that people always need to clarify, in that if you're in multiple funds, you've got multiple costs. If you're in a single fund, then clearly the theory is that the cost will come down. It also helps if you've got this, to meet this current definition of Australian super fund. Now, this is also a budget announcement that we're waiting for a little bit of information on, but or waiting for some updated legislation. But if you had more than 2 members in a self-managed fund, then it would allow you to have 50% of trustees in Australia if some other people travelled, and so it was easier to satisfy the requirements to meet that definition of an Australian fund. So that's quite a positive measure. On the negative side is that a lot of trustees have historically been written to say a self-managed super fund is a fund with fewer than 5 members. So if you're wanting to update your fund or add members, you will need to make sure that your deed provides for it. Now, a lot of them had provisions in there which just reference the definition of a self-managed super fund in accordance with the law, in which instance you wouldn't need to make any changes. Individual trustees, again, it comes down to, and I'll talk about it from an investment point of view, naming conventions and other issues associated with the more individual trustees you've got, the more administrative issues you have associated as members come and members go, and members get married and change name if they change their names. As members pass away, you're having to do more updates from an administrative point of view. So it can be more complex with the more people you've got. And the control issue really does become a little bit about all elements of the fund. Who actually controls the fund? With more people involved, does it actually diminish the powers of existing trustees? And does it mean that there's a lot more indecision around investments, which flows into the next sort of positives and negatives? And that is that from an investment point of view, you've got the capacity, yes, to pool your investments, giving potentially greater purchasing power. And that means, you can utilise, say, franking credits that are linked to retiree members to offset tax on contributions for accumulation members. So there's all these sorts of taxation areas that are beneficial. But there's also, some investment statistics that I've seen over my time in self-managed super funds, where the bigger the fund, the less decisions that get made, and there's obviously more investments held in cash. So, there are all sorts of positives and negatives from that investment side of things that flows through from having more people involved in the decision-making process. And then the question of whether they are actually involved in the decision-making process, because they do need to be once they become a trustee of the superannuation fund. And I think that sort of flows through to the investment strategy element of the self-managed fund, that it's not just a regurgitation of the law document. And we know the tax office have taken a larger focus, and fund auditors are taking a larger focus on the investment strategies of the fund, that we have to tailor it potentially to the needs of the members, and consider the risks and all those diversification, the capacity to pay benefits. So if you've got accumulators and retirees, do we have the capacity to pay benefits out to those retirees along the way? So all of those things form part of that investment strategy requirement, which makes it for a bigger investment strategy than, say, a single member or two member fund. Just another question: if corporate trustee, can the directors just be one of the members rather than all six of the members? No. So if you've got a corporate trustee, the membership versus trusteeship rule or directorship rules still apply. So if you've got 6 members, then you need to have 6 directors of that company. So again, what it means from an asset naming point of view, it's simple, because all the assets are just held in the name of the corporate trustee. But you've got all the members listed as directors, and the only time they're not going to be directors is if they've been appointed, or if someone else is appointed in their place under an enduring power of attorney, or if they're a minor under the age of 18 and can't act. So the standard trustee rules apply. So yeah, if you do have a corporate trustee, you still need to all be directors of that corporate trustee. And as I said, I'm going to touch a little bit in a moment on the whole concept of director IDs, which is a new measure. And then the final part is the benefit payment side of things. And so there's this misconception by adding people into a super fund that you can retain the assets of the fund. And look, the reality is that if there is more members and they have greater balances, then potentially you can replace or use their cash part of their balance to pay out a benefit to retiring or deceased members' beneficiaries. But you can't just transfer the assets that existed from one member to another in the fund, because you've got to have the membership valuation. So there are some key issues there. So just another question back on the investment strategy side of things. There's going to be such an emphasis on what is in the investment strategy. Does the current investment strategy provided by Express Super, which is one of our 2 service provisions, is an adequate document? So look, that's a really good question, because there's not such an emphasis on what's in it so much as far as the way that it's written. It's more that it contemplates all the sets of circumstances. So you don't have to be asset specific in your investment strategy. What the tax office are particularly mindful of, and I'll use the example of limited recourse borrowing arrangements, is that they wrote a letter to a number of self-managed super funds, around 20,000 a couple of years ago, to say your fund is investing in limited recourse borrowing arrangements exclusively, so there was no other assets. So it's like, have you considered the diversification of your current investment strategy? So they don't see merit in saying that you're investing in various asset classes with a range of 0 to 100%, because it's not actually stating anything. So what they really want to see is, they don't care whether you have asset ranges so much in your investment strategy, but that if you're investing in certain types of assets, that those assets are accommodated for in the investment strategy. And yes, what we've done with our templates, and we're continually reviewing these, and I know we had a roundtable discussion about it the other day to do some more enhancements to our templated investment strategy. What we tend to do is provide for the capacity for trustees to be quite specific with regards to, say, asset classes and percentages. So, you know, X% in property, X% in cash, X% in listed securities, etc., or to be more asset defined and say, you know, we're going to invest in a single class asset, such as property, you know, with a capacity to diversify later to meet our liabilities. So, you know, our investment strategy, our templated documents are certainly always work in progress, and we're always in communication with our fund auditors as well with regards to whether or not it satisfies their requirements. So always pretty mindful of those things and how they work. And just one other question on the 6 member funds. If children are members but don't have any contributions, but the parents hold property, upon the death of the parents, can the children then own the property without having to transact a transfer via lands title? The short answer to that is no. I guess there's a longer answer, and it depends on how old the children are, because if the children are under age 18, then potentially they could be paid a pension, so the asset could be retained in the fund, and an income stream paid out for the children. But if the children are adult children, and there's no money in the fund, so they have no member balance inside the super fund, then they can't just take over the ownership of the asset without any of those land title issues. They can be paid a death benefit from their parents and receive the property as part of that death benefit, but that is going to require a change of ownership. And it's also potentially, subject to their age and the components of the super fund, going to have a benefit payment tax liability attached to it as well. So there are ramifications of a property being held inside super and being the illiquid style asset of the fund remaining when members pass away and wanting to pass that on to other beneficiaries. So all of these sorts of things are fairly significant, and great questions coming through about how they tend to operate there. And I think that's probably a good time to jump in before I go with the updates. Go back to the question about the binding death benefit nominations, because we're talking about benefit payments here. Asking for clarification on binding death benefit nomination rules. Do you require a separate will to validate the binding death benefit nomination? And secondly, who can you not nominate as beneficiary upon death? So basically, in very simple terms, wills and super funds are two quite distinct documents, and binding death benefit nominations are distinct from the will. So what you do in your will is separate to what you do in your superannuation fund, unless you specifically, via your binding death benefit nomination, nominate the executor of your estate or your legal personal representative to receive the money. And so if you nominate your legal personal representative, then the money will go out and will form part of your estate, and then it's subject to the provisions of your will. Otherwise, it's not linked at all, and the binding nomination can deal with the death benefit in accordance with your wishes, which then leads to the second part of the question: who can you not nominate? It's probably easier to say who you can, because you can nominate your spouse, your current spouse. You can nominate any of your children. You can nominate your legal personal representative. So if you want other parties to receive it, you would have to have the money flow through the will. Or you can nominate someone who is a financial dependent or in an interdependency relationship. And that then starts to deal through the ramifications of the nature of the relationship, how that relationship is viewed, what sort of personal care and financial support is provided through that relationship. So in the majority of instances, we're talking current spouses and children as the recipients. And then beyond that, largely the legal personal representative being the estate. And then in more remote circumstances, these financial dependency style relationships, which can often attribute siblings, and if a child has passed away and they lived with and provided financial support to the parents, and it can provide in those circumstances as well. So, all of those areas are fairly relevant. And, having an estate planning session as one of our future trustee presentations is certainly an area that I have on the agenda to be able to do for you all. And so to give you, and to finish off with a trustee, a bit of an update as to the current state of play, I've highlighted, because of some of these great questions that have come through, I highlighted under the corporate trustee structure this requirement for director IDs. So if you've got a corporate trustee and you run your fund with us, then it's quite likely that you received an email earlier this week telling you about director IDs. They came into effect from the 1st of November 2021. For all existing directors on the 31st of October, you don't need to have an ID until 30 November next year. However, it's in your best interest to start acting on it now, so that you give yourself plenty of time to go through the process of actually applying, because applications, it's not something that we can do. It's not something that another party can do for you. You actually have to, unless you want to go through some form of phone process with the Australian Business Registry Service, you will need to apply through MyGov ID. So you need to have a MyGov ID to be able to do that. But ultimately, these director IDs have been introduced to assist ASIC and others verify and give greater transparency to existing directors, so that people, let's say somebody is insolvent and they therefore try and set up another company to avoid those insolvency issues or whatever, or the insolvency is linked to one company, but then they've got another company act as their trustee of their self-managed super fund. Well, the tax office might not necessarily see that other company there, and therefore not advise that they have to be removed as trustee of the fund. So by having director IDs, it applies to you indefinitely and across all your companies. And so the link there gives you the process, and the email gave you the process of what you need to do to obtain a director ID, and then just notify us of that, so that we can record that number on our system. But again, if you've got any questions in relation to the director IDs, then by all means reach out to your client managers. So last presentation I did for you, I introduced some of the federal budget announcements, and a couple of those announcements have now moved on into the draft legislation stage. So we've had draft legislation released at the end of October. Now this, as I said, is not law yet. And if it comes into effect, will come into effect from the 1st of July 2022. But eligibility for downsizer contributions, so previously it was age 65. What this means is that anybody prior to age 65 and above age 60 who sells their primary place of residence will be able to contribute up to $300,000 after 30 June 2022. Now, there's a caveat to that, and that is that if you are not retired, then like all contributions, they will be preserved. So you need to be mindful of how that actually operates in that space. Sorry, I just missed one question there. Does director IDs also apply to corporate trustee of family trust? It basically, look, it applies to every company. So if you're the director of any company, it will apply. So for all companies, all Australian companies that you're a director of, or if you are a director of or contemplating becoming a director of, then you will need a director ID. So absolutely applies to any instance where you have a company registered for ASIC purposes. But of course, if you're a sole trader and operating under your individual tax file number, then in that instance, you're operating under that rather than under Corporations Act and ASIC requirements there. So yeah, so downsizer eligibility will move to 60, but contributions will be preserved until you meet a condition of release. The first home super saver deposit withdrawal will be increased from 30,000 to 50,000. Now, I see this as being a bit of a a bit of a quirk, because they say this will speed up the process for people to be able to save for a deposit on a home. However, it's still limited to $15,000 contributions each year that you can make and have counted towards the First Home Super Saver scheme. So in essence, it means to take out 50,000, you're still going to have to contribute over a 4-year period rather than the current 2-year period for the 30,000. So it doesn't actually speed up anything. It just gives you a greater capacity to do that saving through superannuation. The key one, so I'll touch on the last one. If anyone earns less than $450 a month, then they will be entitled to super guarantee after 1 July 2022. But the bigger one is the removal of the work test. So basically what that means is that for anyone aged between 67 up until their 75th birthday, you'll be able to make non-concessional contributions and salary sacrifice contributions without satisfying the work test. So that will basically mean that right now, once you're over 67, you have to do 40 hours in 30 consecutive days. By introducing this change next year, it'll give that capacity for anyone over the age of 65, which was ultimately where we started with all this. From 65 to 75, it will give you that capacity to make after-tax contributions subject to your total super balance, so those rules don't change, including using the bring forward provisions up until that age of 75. Post 75, you'll still be entitled to do downsizer contributions. You'll still be entitled to mandated super guarantee if you're an employee, but you won't be able to make any other personal contributions or personal deductible contributions from age 75. So that's a fairly significant one on the concept that it gets passed and comes in. So, time will tell there, but it's a relatively positive measure, and it will certainly assist in regards to things like fund audit and that, where you don't have to prove that you've worked 40 hours in 30 days. If you're over 67 and you've got less than the $1.7 million, you'll be able to use non-concessional or make non-concessional contributions. Similarly, if you've got appropriate cap space, you'll be able to use the bring forward amount. So currently, if you've got less than 1.48 million, you can contribute 330,000 and bring that forward now rather than doing it over the following 2 years. So, that's quite a positive measure should it proceed to a final act. What we don't have yet is changes in regards to the residency test and changes in regards to those clients with legacy pensions that applied before 2007. So some of these rules will still wait to see what more or what additional legislation comes out, but we haven't got any further announcements. As those announcements come out and as we potentially get law on those draft proposals, we will keep everybody advised on that. So look, just to finish off, just to summarise, wrap up the session, basically SMSF expenses are under the spotlight. So we do need to be mindful as to what we're doing. But if we keep things commercial, then we keep things clean from a taxation point of view, and that's clearly what we will want to do. We use superannuation for saving mechanisms to provide for retirement. The last thing we want is a high tax rate there. Make sure from a transactional point of view that we pay all of our transactions via the self-managed superannuation fund. And if you're unsure of whether a transaction should or shouldn't happen from the super fund, then do your research, which includes give us a call. Because the chances are we've had those sorts of transactions occur before, or if not, we'll certainly do the research from our end as well to help you out there. Now, sometimes the answer is going to be that you need to go and get advice from the tax office, but that's not always necessarily a bad thing. From our SMSF director's point of view, you have got time to act, but don't wait too long. So don't leave it till the last minute to operate under that situation and get your director's ID, and that those budget announcements are not going to commence until 1 July 2022. So I've got another question. Can you now transfer cash that you may have inherited to your super provided you meet the criteria? So yeah, so ultimately, well, I can't say yeah because the law's not in yet, but basically if you are between 67 and let's say 74, so you have to contribute within 28 days of your 75th birthday. So it's just far more convenient to say 67 to 74. If you meet that criteria and you've got less than $7 million in super, being the current general transfer balance cap, then you can contribute $110,000 non-concessional. If you've got less than 1.59 million, you can contribute 220,000, and if you've got less than 1.48 million, you'll be able to contribute $330,000. But as I said, that's all subject to the law passing and will all be in effect from 1 July 2022. Right now, the restriction is 67. So up until age 67, there is no work test requirement. After age 67, you do have to satisfy that 40 hours in 30 days. So look, great questions today. If anybody's got any more questions, then chuck them in the box and I'll answer them right now for you. Otherwise, you can always send your questions through when we send out the copy of the slides with a couple of those links. Always happy to take any more questions that you might have at that point in time. So look, thanks for joining me in the presentation. I hope you got some value out of those points. As I said, we'll keep you up to date, particularly on how all those legislative matters progress, but also as we hear things on fund expenses, we'll always make sure that you as our clients are passed on that information. So thank you very much, and I look forward to catching up with you early in 2022.